Hello, everybody. Ed Denny here. Nice to visit with you. Thanks for joining us. We got a nice audience today, so lots to talk about. Clearly, this is Liberation Week. On Wednesday, the president is going to announce his tariffs. Seems as though they haven't quite decided what they want to do, so it's going to be a work in progress or in on Wednesday, I suppose. We're expecting reciprocal tariffs, obviously, but the game seems to be changing from aiming at 15 countries. Somebody in the administration came up with the term "dirty 15" to disparage countries that have trade surpluses with us, that we have trade deficits with. But now the president is talking about imposing tariffs on everybody. And then, of course, we've got a lot of economic indicators. Oh, by the way, I'm doing this solo. My good friend and colleague Eric Wallerstein has is going to be on a leave of absence, and he's going to accepted a position at the President's Council of Economic Advisors. So he's going to go right into the storm, and he'll have firsthand insights, I suppose, into how things are going with the administration and Washington generally. Eric seems to have a knack for being at the right place at the right time. He was at the Federal Reserve Bank of New York during the pandemic, and I give him credit for having rescued us. So maybe Eric, who is of sound mind and very smart, I hope he'll have an important impact of bringing some common sense to Washington. Not always the easiest thing to do, but it'll be a wonderful experience for him, and we wish him luck, of course. Anyways, back to the story here. Like everybody else, we've been increasingly concerned by the chaos, upheaval, uncertainty created by Trump 2.0, especially on the tariff side. During Trump 1.0, they started the other way around. During 1.0, they started out with tax cuts, which were implemented at the beginning of 2018. And then Trump went for tariffs, but it was mostly focused on, well, there was a renegotiation of the trade agreement between Mexico and Canada. And that seemed to go along pretty quickly and smoothly, nothing like what we're experiencing now. And in addition to that, obviously, there was a lot of tariffs imposed on China. And all in all, there was some slowdown in the global economy, but really didn't have much impact on inflation. In 2018, 2019, actually, inflation remained fairly moderate. But here we have a whole different kettle of fish, as they say in New England. And the idea here is that the tariffs have become a much bigger deal in Trump 2.0. The president has in the past said that he loves the word tariff. He thinks tariffs can accomplish all sorts of things. As within the art of the deal, I think he believes that tariffs are awfully good as negotiating tools. But then there's some contradiction, because if you're going to use tariffs as a negotiating tool, then presumably that means that if the negotiations lead to an agreement, then you're not going to impose the tariffs, or you're going to simultaneously, in a reciprocal way, lower tariffs. But and they're in any event, they would be transitory. They're being used as a stick for negotiating purposes. However, at the same time, somewhere along the way, President Trump became convinced that it's also could be a great way to raise a lot of revenue. And so now all of a sudden, they're talking about reciprocal tariffs of 20% on everybody. And I think they're kind of haven't made up their mind what they mean by that. Do they mean that they want to negotiate with everybody to bring tariff rates down, or is the president kind of having second thoughts about making tariffs transitory, and he kind of likes the idea of having a 20% tariff across the board? I think that would be substantial in terms of revenues that would come in if nothing changes. I think if we use the number like $4 trillion for imports at an annual rate, I apply a 20% duty on that, and you get $800 billion. So it's a sizable number. But to believe that imports won't be depressed and exports won't be depressed and global trade won't be depressed by the United States imposing a 20% tariff across the board, I think that's not very likely. And the risk of it leading to a trade war with other countries saying, well, if the United States is looking at it as a way to raise revenues, we could do the same. It's just we don't really want to go there from a global free trade perspective, and that would be the ideal, is to get everybody to lower their tariffs, not to make them permanently higher. But that's the confusion that's occurring right now. Maybe there's a debate going on within the administration, but at the end of the day, it seems it's very clear the president calls the shots. The other thing about tariffs is the president is convinced, and maybe first and foremost, he believes the tariffs are essential for national security purposes. So the tariffs on steel and aluminum, and I think possibly copper, I don't think those have been imposed yet. See, I missed my buddy Eric. I would have asked him to corroborate that, but that's okay. We wish him well. I'll have it to do it solo, Eric. So, anyways, back to the story here. Aluminum, steel, and copper tariffs. Sounds like the administration intends to make that permanent. We want the administration wants a permanent incentive for more production of steel, aluminum, and copper in the United States. And again, that's being billed as for national security purposes. And then the thing that kind of got my attention this past week is autos. Slapping on a significant tariff on imported autos. That's going to be, maybe in the long run, that'll bring more car production in the United States and more employment. Though, we are at full employment at 4.1%. So for all this talk about we need to do all this for workers, it kind of raises the question of which workers are available to operate all these new plants. But the idea, of course, is to bring more production in, but drastically overnight changing the cost structure, the supply chain assumptions on a global basis of a major industry like autos is extremely disruptive. And I think everybody agrees, outside maybe of people in the administration, it's widely agreed that these tariffs on autos are going to lead to higher auto prices. And if they lead to higher auto prices, then we're already familiar with what happens when auto prices go up. Auto insurance goes up, maintenance goes up. So this is all adding up to an increasing probability of some stagflationary event. I think I was watching on one of the financial news networks, maybe it was Jim Cramer was saying that he didn't think that this is a stagflationary environment like the 1970s. Jim's absolutely right about that. I don't think we're looking at a whole decade like the 1970s of stagflation. But if stagflation is a very weak growth, maybe even a shallow recession with higher inflation, that's our forecast now. So we were thinking when we were putting a much larger weight on the Roaring Twenties scenario, we were looking at some pretty good outlooks for the economy, where the economy would be continuing to grow 2.5% to 3%, which is just the same as what it did last year. There's no particular reason why it couldn't continue to do that, particularly if productivity makes a comeback, as is the assumption of our Roaring 2020 scenario. We haven't given up on that. We are still using that as our base case. But at least for the short run, we're not giving it 65%, we're giving it 55%. And that means that the alternative scenario, we folded in, remember that melt up, melt down scenario? We folded that into the roaring 2020s, the bullish scenario. The reason for that, of course, is it kind of feels like we've had a melt up, melt down scenario. And so far, it's really been more a correction, obviously, than a meltdown. But the chances that this becomes more than a correction, and we still have some room here. We're down 10% basically in the S&P 500. We're down somewhat more than that in the Nasdaq. But a correction, you could be down 10 to 20%, and that's still a correction. It's basically a valuation sell-off, lead sell-off, where the economy continues to grow and earnings continue to grow, and you come out of that correction with a continuation of the bull market. We may very well be in the bull market that started in October of 2022. Just the odds of that are diminished from 65% to 55%. So the odds of stagflation, which includes, in my mind, the potential for a shallow recession, we've raised that from 35% to 45%. I think I've given you a warning before, or not a warning, I've alerted you to the possibility that I'll be changing my mind more often. This is kind of a new experience for me. I'm not used to changing my thinking as often as I have been recently. You know, we had a pretty good run there over the past 3 years. Always nice to go back and have a little nostalgia. But oh, I miss those past 3 years when everyone was talking about a recession and we were not. And we didn't have to change our forecast. And some of our most delusional, optimistic forecasts on the economy turned out to be dead on right, including on earnings for last year. But things have changed. We've got a regime change in Washington. We've got a president who seems to change his mind or create nuances that hadn't been thought of before. And that has to be incorporated in our thinking, your thinking, my thinking, as we're thinking about the where the financial markets are going. So right now, we kind of have to take at face value that what I now call Trump's reign of tariffs is continuing to be the obsessive policy of this administration, and that it's getting to be more of a problem, not just for the U.S. economy, but for the global economy, hence for the change in subjective probabilities. Let's have a look at some charts here that are relevant to our discussion. Okay, let me make this a little bit bigger. Okay, here we go. So figure one shows the yearly percent change in capital spending on equipment in real GDP. That's the red line. And then there's the CEO Economic Outlook Index. And as you can see, that's the blue. Looks okay. It doesn't really look troublesome. And it's for the first quarter. But it was actually, that survey was taken before Trump slapped tariffs on Mexico and Canada, before people started to realize that this tariff issue was going to be a troublesome issue for the economy and for the markets. So when this survey will be taken, I think it'll be in early April. I would expect to see a significant decline in that. And this relationship would signal that could, at least on a short-term basis, weigh on capital spending. The offset is, the president has announced that companies are committing to spending more money in the U.S., but it takes a while for all that to happen. And so there may be golden age positive consequences of all this, but in the short term, as even the administration has fessed up, we got to be ready for some pain. I've observed that we Americans don't do pain very well. Being promised the golden age in exchange for taking some pain right now is not necessarily something Americans welcome. We want to go straight to the golden age. but this administration is convinced that we got to go through some pain in order to get there. By the way, I'm not being political here. I was just as positive on the economy and stock market during Biden as I was when Trump got elected, and I thought that animal spirits would prevail. Well, animal spirits have been kind of overwhelmed by uncertainty. And so here's a chart of the uncertainty index, which got to an all-time high when Trump got elected, because it was a regime change, obviously, and Trump was talking about a lot of radical changes. Then the uncertainty index came back down, and now it's right back up. So this is the small business uncertainty index, and there's plenty of other ones out there that show that there's lots of uncertainty. This is another chart of kind of confidence. And again, there seem to be more animal spirits generated by Trump 1.0. As you can see here, this is what we call the consumer optimism index, is simply the average of the sentiment index and the confidence index. And as you can see, the green was strong. The confidence index was very strong. The optimism index, which is an average of these, there's something wrong with the consumer sentiment index. It always seems to be kind of much more depressed than the consumer confidence index. I like the confidence index more because it's happier. But it does seem as though there's sort of the CSI respondents, or the way they calculate this thing, is more depressing. You can see that generally speaking, the CSI is lower than the CCI. But again, taking the average, we see that there's been a drop in confidence at Trump 2.0. Maybe there was a little bit of a pickup in confidence there initially when he was elected, but it fell off sharply. Now, the CSI is very affected by partisanship. Democrats tend to be much more depressed than Republicans, and they do have that data. So consumers are depressed, and we've been saying, well, Americans are great. When we are happy, we go shopping. When we're depressed, we go and shop some more. But maybe that's just not going to work out this time. And one of the concerns, of course, is as the stock market continues to go down, we'll have a bigger negative wealth effect. And then this happy story we were telling about the baby boomers retiring, sitting on a whole bunch of net worth, becomes stressed out a bit, because people who are retiring or retired and see that their net worth is declining, at least on their equity portfolios, it's not a good time in one's lifetime when you're retiring to see your net worth being eroded. Obviously, over the past, since October of 2022, people retiring were a lot happier being on their cruise ships and being able to see on their cell phones that their stock portfolios were going up. Now it's going the other way. This is the consumer optimism component. So this is the optimism, and then you can see that what's really bringing this thing down is expectations. So maybe people are just getting too pessimistic about the future. Maybe they don't realize how great these policies are and how quickly they're going to deliver a golden age. Or maybe they start to become self-fulfilling, and people start to say, well, I'm less and less confident about the future. I better hunker down. And then you get a consumer-led retrenchment and a recession. This is another a couple of more indicators from the consumer sentiment survey, and you can see that the 5-year expected inflation rate jumped up, and you just don't see a level like that for the data that's available. And you can see that the 12-month ahead has also jumped up a lot. So the consumer sentiment index does tend to be more sensitive to inflation than employment, whereas the consumer confidence index tends to be more sensitive to employment. But that doesn't tell a really good story either. This is the consumer confidence survey, jobs in 6 months. And fewer people are saying that they expect the same amount of jobs as now over the next 6 months. And that's because more of them are saying that they see fewer jobs over the next 6 months. And I have seen some charts which will duplicate, showing a pretty strong correlation this can be a good predictor of what the unemployment rate is actually going to do. So that's an issue. I know this is all called soft data, and we've been not giving it a lot of weight. But given that there's our concerns that these tariffs can be stagflationary, we're giving more weight now to the soft data. How about in the credit markets? In the credit markets, we're not seeing problems yet, but we're seeing a little bit of an uptick in the spread between the corporate, between the junk yield and the 10-year, pretty highly correlated with VIX. And the thing about both of them is out of the blue, they go straight up when everybody concludes that things have deteriorated to the point where the spread is way too low. So this is not going to be a leading indicator. It's just going to be, we're going to wake up one morning, it'll be up like that. I'm not saying it's going to happen, but it's something that could happen if this thing unfolds into a recession and credit issues become a problem. Speaking of credit issues, here's another indicator of sort of confidence in the credit markets. This is junk bonds, and the junk bond ETF is actually telling us, don't worry, be happy, which I'm more than happy to accept. But we try to be realistic, and this is an indicator of leveraged loans, and so we'll be watching that to see what the credit markets are showing in terms of the impact of Trump 2.0, the reign of tariffs, as I call it, on the economy and therefore on credit quality assessments. So here we go. We got the stock market, the S&P 500 down in correction territory. I guess we're toying around with correction territory. And that's been a swift drop here, quite an unusual drop in such a short period of time. And it seemed to be related to a lot of Trump 2.0. Now, to be fair, it's not all Trump. There's also a lot of questioning of the AI phenomenon, where more people are saying that, well, it turned out to be just one big bubble like the dot-com. I'm not in that camp. Jackie Doherty was going to join us today, but we had a technical glitch, so she wasn't able to join us. But Jackie has been writing some articles on utilities and on the data centers. And the real estate data shows that the demand for data centers is still pretty strong. But then you get these stories about Microsoft canceling some deals, but then somebody else doing the data center after all. Look, I think there clearly is going to be growth in data centers. And it's, I think what AI is doing is allowing us to process more data. And as we process more data, we're going to need more data centers. But there could certainly be a situation where, kind of like with semiconductors, too many are built, there's too many orders, and there could be a correction. But I don't think this is anything like the dot-com bubble situation. This is the NASDAQ. So much for the channel. Let's see if we can get it back into that channel. But right now, that's not working. Meanwhile, I guess we can take some comfort that most of the decline has been in the Magnificent Seven. They're less magnificent. Excluding the Magnificent Seven, we're basically flat for the year. We've been thinking that there would be some rotation from the Mag 7 to the 493, but it looks as though a lot of the rotation might have gone to China and Germany, Europe generally, to overseas markets. We're not, this is, by the way, the data centers. There's an S&P 500 data center REIT index that we're following. And right now, clearly, people, the market is confirming that the pessimism about the data center story. Meanwhile, through a couple of lines here. Let me just turn this off. Let me just draw we draw a couple lines here on the ratio of the MSCI to the all country world ex-US indexes, both in local currencies and in dollars. And, I mean, technical analysis sometimes works, sometimes doesn't. I'm a total amateur when it comes to technical analysis, but I kind of use this as a thinking, well, what might keep this thing from going straight down? And the answer is, well, people might start to realize that Trump's tariffs could hurt foreign economies as much, if not more, than the U.S. economy. And we can kind of see that. This is an interesting chart. This is the Magnificent Seven using the Round Hill Magnificent Seven ETF. And then this is the China Invesco Technology ETF, which had a great rally here as apparently it looks like people left the Mag 7, went into China for their AI stocks. And then people realized maybe that the AI story is questionable here, it's questionable there. And so we've had some sell-off in that area as well. Meanwhile, Trump's tariffs are raising copper prices, raising up steel prices, aluminum prices, and so the inflationary consequences, the inflation and stagflation is certainly an issue. And as I mentioned before, putting permanent tariffs on autos will increase auto prices, maybe not immediately. We're thinking that the first quarter might be like 1% real GDP growth. The second quarter might be surprisingly strong. We still think that the weather had a lot to do with January and February's weakness in retail sales. So we think consumer spending is going to be actually pretty strong in the second quarter. And in addition to that, there may be a lot of buying of the autos at the dealers before the sticker shock hits in the tariffs. And that sticker shock, repeat that 10 times, sticker shock may hit in June. So we could have a very strong auto sales in April and May. And then stagflation sets in with a weaker second half of the economy as people respond to the higher prices and the fact that there might have been buying in advance that leads to weakness in the second half. So roughly speaking, 1% growth in the first quarter, maybe 3% growth in the second quarter, and then 0.5 to 1%. Some growth recession. And the numbers could be negative if Trump persists with his reign of tariffs, as they call it. So the problem with auto prices going up is that's not the only price that's going to go up. We're also going to see that auto maintenance and repair will go up and insurance prices will go up. Very reminiscent of what happened over the past couple of years. This, by the way, as we've shown this before, industrial production of utilities, record high, the highest record high for January seasonally adjusted, the highest January ever, and February was the highest February ever. So we think the weather really had an impact on slowing the economy down. And we've been arguing the economy is resilient and everything's going to be hunky-dory, but we've lost our confidence in that story as a result of Trump's tariffs. This is personal consumption expenditures deflator. We're now thinking that'll be 3 to 4% over the rest of the year. It'll get a big jump from these tariffs, particularly in the goods side. Goods is where we've had deflation of late, and now that's going to stop. We still think we're going to go back down 2 to 3% next year. We haven't given up on our roaring 2020 scenario. We're just making, realistically recalibrating it, fine-tuning it for the realities of what the administration's policies seem to be doing now. This is the consumption deflator for services. That might continue to moderate, possibly in a slow pace. So that could be all right. On the other hand, the goods inflation, which had been deflating, particularly durable goods, could get a boost from the tariffs. What else? Another sign of stagflation is looked like we were starting to improve on the manufacturing side when you look at the regional business surveys. But now that seems to have turned over when you look at the regional data. And then this is not happy. These are not happy charts, which is also kind of concerns on the stagflation. These are the regional business surveys, prices paid. You can see that they've moved higher. And this is the regional prices received. They're, I don't know, they're stuck going down. But this is obviously concerning, and that's obviously not good for profit margin. So in our happy world, the roaring 2020s, the economy would continue to grow at around 2.5% to 3%, maybe better, as productivity picked up, um, technology-driven productivity. That's still our story. We still think we're going to get to 10,000 on the S&P 500 by the end of the year. But we didn't think we were going to have a recession until we saw the extent to which Trump was was becoming more pervasive in how he's using tariffs. So let's. I've gone beyond our half hour, and let me just take a couple of questions, if you don't mind. I see some of you're all hanging in there, so if you're hanging in there, I'll hang in there. So Mitchell, thoughts on tech versus other sectors during a potential recession? Are their earnings more resilient? I think they're resilient. Their earnings are more resilient than they were during the tech wreck. I don't think this is the tech wreck. I don't think this is the dot-com bubble. I mean, clearly there was benefit of hindsight. Valuations were high, so we're seeing a correction in valuation. But the earnings share of telecommunications, communication services, and information technology is about 35% of the S&P 500 now. It was 25% back in right before the tech wreck. And in both cases, we peaked at 40% market cap share of those two sectors. So the market cap share is coming in, obviously, as these stocks correct. But a lot of it is, in fact, the Magnificent Seven. And semiconductors, of course, which includes NVIDIA. Okay, William, regarding tariffs, is the national security argument a mere charade to keep Congress out of the loop? If the primary goal is revenue, is that not the domain of Congress? William, your question clearly indicates the confusion about what, not your confusion, but the confusion that the president has created about what tariffs are all about. And it seems to, depending on how he feels in the morning or in the afternoon or on a weekend, the message changes on tariffs. I don't think there's a realistic chance that revenues raise tariffs. And if they try to slap a 20% tariff to get $800 billion at an annual rate in revenues, it's just not going to happen. I mean, they're just going to create a trade war. Our imports will drop. Everybody's trade will drop. It would not be a happy story. Norm, with a goal to reduce the deficit, what could be the logic to no taxes on anyone earning less than 150,000? Yeah, I mean, there's a lot of inconsistencies in these policies. Eric, I'm sure Eric's listening in. Eric, when you go down there, Eric's actually going to start in early May. So in early May, everything's going to get better when Eric goes down there. But there's a lot of inconsistencies. I mean, removing taxes on tips on Social Security and all these things, and then of course renewing the tax cut. These are all going to reduce revenues or keep revenues from covering outlays. And I think I just kind of detect there's kind of a not a desperation, but just kind of like a hustle to try to figure out some way to get revenues, like selling citizenship and other trinkets. Gus, Ed, doesn't your 2020 scenario accelerate as more capital equipment will be invested, enhancing productivity? Well, Gus, yeah, thanks for that. Yeah, I'm not giving up on the roaring 2020s. I don't know. Maybe I should just do a victory lap and say we got the first half of the decade right. And the problem with the roaring 2020s analogy is obviously it's being compared to the 1920s. in the 1920s ended very badly with the Smoot-Hawley tariff. Maybe we're just kind of on a speed here where we had the roaring 2020s for 5 years, and then Trump comes in with tariffs that create the problems. But no, I think we'll get through this. Um, I think the Republicans and even the president may start to understand that they're increasing the chances they're going to lose the midterm elections if they keep on this path of stagflation, and then they'll change their policies. And this president is capable of changing pretty quickly here, especially since he does things, as you said, without having any input from Congress. Let's see, Cagdis, hi Ed. Once we have the tariff event out of the day and dust settles, how are you thinking about when we see a golden age or roaring 20s pivot from the administration? Do you think it is more dependent on the level of stock market drawdown or rather timeline of broader policy goals? Uh, I guess I'm kind of struggling with that right now. Right now, I'm kind of sticking with the idea that this too shall pass, that this will probably last a few more months. The economy will look weak. The stock market. I've been talking about the stock market vigilantes. Maybe we should all just sell today, create a flash crash, and then buy at the lows. But we need something to scare the living daylights out of Washington. Typically, and by the way, I've been making this point that when sentiment is this bearish in the stock market, you usually want to be a buyer. The problem is that when sentiment is this bearish in the past, what made the bottom V bottoms is it would trigger the events that caused the bearishness would trigger a fiscal response. Well, actually, more a Fed response, right? A Fed put, and we get a V-shaped bottom. I'm looking for that. I've had a pretty good record of calling bottoms, so I'd love to call the bottom of this thing, but I don't think we're necessarily there yet. But things move pretty quickly here, and we may get to a point where the market gets the administration's attention. I think we've kind of run out of time. I apologize for those of you that I wasn't able. Oh, we had a whole bunch of questions. So send me your emails, eyardeni@yardeni.com. We'll respond to it. We had a nice big audience today. I look forward to our call next week. And Eric, all the best. We wish you luck, and please bring common sense there, which you have plenty of. Thank you.